Can you beat the market? In 2007, Warren Buffett, you probably heard of him, put $1 million bet down against a man named Ted Sietes, and Sietes was a hedge fund manager. Now, Buffett bet Sietes that a simple S&P 500 index fund would outperform a basket of 5 hedge funds that Sietes had picked, and they had 10 years to look at the results. The official bet ran from January 2008 until end of year 2017. So who won? Come on, they don't call him the Oracle of Omaha for nothing. The final results, the S&P 500 index fund had an annualized return of about 7.1%, and Sietes picks, just 2.2%. So I guess you can't beat the market. Now, side note, this is not to say that passive management works better than active management. You just have to figure out what works best for you and your goals. But this whole bet raises some underlying truths that are much bigger, in my opinion, than who gets the higher return. And that truth is, you don't need to beat the market. I'll say it again. That truth is, you don't need to beat the market. The majority of regular everyday people who attain financial freedom don't beat the market. They don't know how to, it's hard to do that, and quite frankly, and most importantly, they don't need to. Why? Because they started early, they consistently added to their investments, and one of the most important things is they have a plan. All they need to achieve their goals are consistent, boring returns over a long period of time. The people who need to beat the market are usually trying to make up for lost time. They're trying to cover more ground and thus taking out more risk and possibly losing a lot more money. So again, forget trying to beat the market, forget who got the best returns or the highest returns. Focus on what you can control. Starting early, consistently adding to that investment over time, and having a plan. Because if you have all those 3 things, you don't need to beat the market. You just need boring returns.